All right, we're live.
Hi, this is Deborah Lucci. I'm the team lead from the Deborah Lucci team from William Ravis Realtors. And this is our first Facebook Live. And we're very happy that you're joining us. And I just want to give you a little bit of background about us. We're located at 12 Bartlett Street in Andover, Massachusetts, probably about 25, 30 minutes outside of Boston. We're a team of 10 people, and we have some of the team members here with us today. Mackenzie Cormier, Nicole Leahy, and Diana Silva. And we sold 142 houses this year in 2020, about $109 million worth of real estate, and we are the #1 agents in our area. So today's topic is going to be about mortgages. We're a real estate team. Mortgages are extremely important. It's very competitive at this time in our area. So we have Nicole's husband, Ryan, on right now, and he works for Mortgage Network. And we have some questions that some of our buyers and viewers have asked us that we'd like to address to Ryan. So, Nicole, you want to ask Ryan the first question?
Sure. Hi, Ryan. Thanks for joining us.
My pleasure.
So I guess the first question that we have here is, what is the difference between a lender and a broker? Because a lot of people don't know that there actually is a difference, or that there's two. So
yeah, no, that's a great question. I get it asked all the time. The basic difference is a lender gives you the money directly, whereas a broker plays matchmaker. So they match you as the client to a lender, and they get paid for that service. So the broker doesn't have the money to lend you. As you can imagine, we're lending hundreds of thousands of dollars on every transaction. So the way it works at our company is we have warehouse lines of credit for millions of dollars. And basically what we do is we use that money to lend someone to buy a home. And then a lot of times we will transfer the servicing of that loan off to another company that will handle the billing. And that servicer will pay us back the money that we lent for the mortgage, which allows us to pay down on the credit line and then ultimately lend to the next person. So.
Interesting.
Okay, awesome. And kind of going off of that, Ryan, what are the benefits of working with a local mortgage broker as opposed to, someone that's at a bigger bank, like Bank of America, for example? Sure.
So local lenders give you a competitive advantage if you're a real estate agent. For instance, in Massachusetts, where we're headquartered, most of the agents out there on the listing and buy side know who we are. So they've transacted with us in the past, and they know we're going to deliver on time at the closing. The bigger banks, keep in mind, this is not a knock on them, but they do car loans, they do credit cards, they do deposit accounts. So we feel as though a local lender is going to have a slight advantage because all we do is mortgages. So we're not here to sell you a CD or help you buy an auto loan. All we do is provide the financing on residential properties. The other thing is, if you're local, you have knowledge about the market. So for instance, right now, appraisals are a big issue, but we know what the average turn time is on an appraisal. So we can set up realistic expectations for all parties on how long it's going to take to do a transaction. And also keep in mind, the local lenders know, are the taxes collected quarterly, like in Mass, or are they annually, like they are down in Florida? So a local lender will be able to have a better idea as the funds you'll need for closing, because they have a finger on the pulse of how the transactions work. So.
Awesome. I've also noticed if you deal with a lender who's, let's say in California, you've got a time difference. Right. And also a local broker or lender, they're going to want to do a good job for you because they're going to see you again, where the lender out in California is probably not going to see you again.
Right. That's a great point, Deb.
Yeah.
That is. So Ryan, what's the difference between a pre-qualification and a pre-approval? I have had clients ask me that.
This is a really loaded question. What we call a pre-approval and what other companies call a pre-approval are actually different. A true pre-approval is actually a commitment letter on a to be determined property. And nobody realizes that. Every loan officer seems to go with their own verbiage of what a pre-approval is and what a pre-qual is. So for us, a pre-qualification, we've pulled credit, we've collected their income docs, we've run it through an automated underwriting system to make sure that we have an approval. The only thing that we haven't done is get those docs over to a physical underwriter that takes a look and goes through the W-2s and pay stubs and matches them up against what's in the file. If we do take that step to get it to an underwriter, then it becomes a true pre-approval. And literally, we can issue a commitment letter for a borrower before they've even found the house that they're going to buy.
So that kind of leads into my next question of when should I really get my pre-approval prior, how good is it for? How long is it good for?
Sure. So pre-approvals and pre-qualifications are typically good for 90 days. And the reason why that's the time frame is after that, the documents have aged, right? So there's new bank statements, there's new pay stubs. So 90 days is typically how good they're for. If there's no change to employment and income and the credit profile's similar, they're really good indefinitely. It just means that the loan officer has to produce a new letter with a new date. So, and in this market, right, you hear about folks, that have been at a job for 15 years, getting laid off. So many things can happen that you'll always want to try to update that pre-approval to make sure that you're not going to have any problems when you find the perfect home. And certainly do so before, going out to look for properties. I see so many people that are, call me and they're like, I found a property today and offers are due today. Mm-hmm. Can you get me a pre-approval? And it can happen, but it's an arduous process. And so always try to get pre-approved before going out to look for properties. Worst thing is finding the property that you love and then finding out that you can't get the mortgage for it. So
so we've had some issues where previously when I used to take out a lot of buyers where it's kind of fun to look at property. It may not be so fun to put in your mortgage application. So I kind of give them the scenario, if we find your dream home on Sunday and you absolutely have to have it and you don't have a pre-approval, you might have to pay to get it, or the listing agent won't even look at you. So if you kind of put it that way, like they find their dream home and they're going to lose it, it kind of makes people move along a little bit to get the pre-approval because it's so important.
Yeah, and giving yourself time in this market is extremely important, right? From a mortgage perspective, we've never seen a market where the refinance market and the purchase market are so good at the same time. So our underwriters are working 7 days a week, working, at 8 o'clock at night. I mean, just to get through the loans in the pipeline. There's $11 billion worth of mortgage debt that could be refinanced right now. And a lot of people are taking advantage of that. So you want to make sure you get it in early to give the mortgage company the right amount of time to do the job and do the job correctly. So.
Excellent. So another question that we as realtors get asked constantly is, we get asked a ton of finance questions, but which type of loan is best for me? And of course, we always defer them to their, loan officer. That's not our forte. So, what type of loan are best for, these different buyers with all the programs?
Yeah, that's a great question. Mortgages are not a one-size-fit-all product, right? So it really depends on the individual. What I try to do as a loan officer is give an individual all their options. I shouldn't be picking whether they do a mass housing loan or an FHA loan or anything like that. I should be showing them those examples and they should be making the choice because I'm not going to be paying their monthly mortgage payment. They are. So to educate them, put them in the driver's seat and let them see all the options and then pick for themselves is the best way to do it. There's statistics on how many buyers have remorse about the mortgage that they did. And I find by educating them, we actually use a great web-based program to compare the options. where we build out a personal mortgage website for our clients. By doing that, I think that buyer's remorse goes away most of the time because they really, haven't left anything off the table. They've seen all the options that they can choose from. So yeah, there's no one good mortgage. A lot of people lean towards going conventionally, which is typically a 5% down product. Those are loans backed by the GSEs, Fannie Mae and Freddie Mac. And that's probably like 60% of the mortgages that are done out there. So those are probably the most popular, but they're not the best fit for everybody. So.
Thank you.
Great. So something that I feel like I typically get from a lot of first-time home buyers is how much money do they need to put down to buy a home?
Yeah, another good question. So, I mean, probably the most popular down payment for a first-time home buyer is anywhere from 3 to 5% down. So Fannie Mae and Freddie Mac have these great programs called Home Ready and Home Possible that allow somebody to buy with 3% down. They are income restricted though. So if you're making over their income limit in a specific county, you do disqualify from taking out that loan. But those are great, great programs to have somebody be able to get in the door with a very minimal down payment. And then of course the 5% down is conventional. We are starting to lean away from going FHA for borrowers. That was a very popular program when I started in the industry, which is almost 20 years ago now. That's a 3.5% down program, and it has relaxed income guidelines and stuff like that. But there's been some changes to that product that have made it less advantageous for borrowers to go in. One is, in a lot of cases, the mortgage insurance, the PMI on the loan never goes away. It's on there for the life of the loan. And people say to me, well, I'll just refinance down the road. And that's fine. But if you've locked in a rate of 2.5% on a 30-year fixed loan, are you really going to get rid of PMI by refinancing it 3 years down the line when rates could be double what you have? And so I always tell them to be careful about that particular product and try to search out for alternative products. So.
What are the discount points and origination fees?
Sure. So discount points can be used to drive interest rate down. So one discount point is the equivalent of 1% of the loan. And you don't have to do them always in whole numbers. So you can do a half of a discount point or a quarter of a discount point. And basically what it is it's money that you're coming to the closing table that is interest. And because you're paying that upfront interest at the closing, you then get a lower interest rate for the life of the loan. So for somebody that plans on being in a house for 5 years, it's typically not a great mortgage strategy because by the time they're getting out of the house, they're just breaking even on the money they brought to the closing within the monthly payment savings. But for somebody that's getting into their forever home, they can save tens of thousands of dollars over the life of the loan by paying some interest in the form of a discount point at closing and then receiving a lower rate for the life of the loan. And origination fees really are any fees that the lender is going to charge you in-house. That would be like underwriting, processing, stuff like that. Those all fall under origination fees now. So it's any fees that are with the lender specifically to get your loan through. But most of it is a result of the process, the underwriting and the processing of the loan to get it to the finish line.
That's interesting. I didn't know that. So I get this question asked a lot to me. And also I feel like I've asked you this a bunch, Ryan, especially how crazy competitive the market is, but how much time do you need in order to close on a property?
It's so market specific right now. Our appraisal desk came out this morning and noted that in New Hampshire, the average appraisal turn time is 5 weeks right now. It's not as bad in Massachusetts, but it is so specific to the area. Yeah. All you licensed real estate agents in New Hampshire, make sure you're building that into your purchase and sales agreement. But Massachusetts, it's still pretty good. We hold the appraisal process in-house. We have an appraisal desk that's out of our Portland, Maine office. And so they're the liaison between us and the appraisers. As you probably know, loan officers can't call appraisers, can't email them because of all the problems that happened in the mid 2000s. So it's a process that we control in-house. I would say on average, what I'm coaching people right now for is to try to have 30 days until the mortgage commitment date from the time the home inspection is done. What that allows for you to do is get the home inspection, digest the results of the home inspection, and decide on whether you're going to move forward with the property or not. If you condense that timeline down any quicker, you may have to order an appraisal before you even have the home inspection results. And who wants to pay for an appraisal of $500 if they don't even know if they're moving forward on the home?
Mhm.
So I say, give yourself about 30 days from home inspection to get to the closing, and then, the commitment date, and then a total of 45 days to the closing. It can be done as quick as 30 days, but the process is torturous for everyone involved, the agents, the loan officer, the clients. It's just a rushed process right now. When this whole thing stops, right, and there's a famine with refinances and everything, we'll probably be able to close in 3 weeks or less. But the market right now is dictating a longer closing time.
Wow.
That makes sense.
Yeah.
What else do you guys have for me?
Nicole, I think. Do you have another question?
Yeah, I didn't know if anyone else wanted to go. So, how do you feel about the commitment being crossed out, even if the buyer is financing a huge dollar amount, like 90%? And I know that, Deb always talks about this too. But yeah, what do you think of that?
I mean, Deb can tell you it's risky. There's earnest money deposit that's on the line, right? And no one ever wants to lose out on that money. But in what is an extremely competitive environment, people are doing it, As I mentioned, you can get a commitment even without having a home. But in a day and age where people can lose a job a couple days before they're going to the closing table, it is a risky proposition to risk that earnest money that you put down at offer and at purchase and sales by not having that mortgage commitment there. And I'm sure, Deb, you can speak to this a little bit more, but there's no real teeth in doing that, right? People still walk away sometimes, and I'm sure there's a fight over earnest money and everything like that. So if a lender denies somebody on your end, what have you seen? Have sellers been, open to returning that earnest money, or what's happened?
Well, I have to be honest with you. Recently, in a multiple offer situation, I've seen someone with 90% financing cross out the commitment. And you would have never seen that a few years ago.
Sure.
And I think it's because it's the only way the buyer feels they can get the house. And, how I've kind of talked to my team about it is, the team members that are a little bit older, we say, treat that buyer like it's your kid. You know what I mean? Don't steer them down the path, because sometimes they totally don't understand that P&S money is totally on the line.
Yeah.
And, if you think about it from a seller's point of view, you go all the way almost to the close. Now this buyer can't perform. They're probably going to take his money. They're going to take that buyer's money. So, I think what it is, we try to present options to the buyers. We try to give them circumstances like and explain to them, if you cross out this commitment, it's more than likely that the seller will take that 5% that you put down to purchase and sale. It's a little bit of a scary situation, but I think sometimes these buyers have been forced to do that because if you think about it, especially like a first-time buyer, let's say they're buying a small ranch home, well, they're competing against the downsizers that are paying cash.
Definitely. It's their only competitive advantage. But then on the other side, that 10% down buyer has probably been working their whole life to get to that 10%. And what heartache there'd be if they lost out on that money and had to start all over again because, they were furloughed from their job because of COVID or something. That's just a heartbreaking story. So we try to coach folks on doing it the right way, coming up with, there's other ways to get a competitive advantage. I know that on every offer with agents that I work with, I call the listing agent and
That's
I say that,
huge.
and I say to them, have you worked with Mortgage Network before? And some of them have worked with me, but most have worked with Mortgage Network. I mean, we've got, I think, 10 or 15 offices all over Mass. We have offices up and down the East Coast, and we've been around for 30 years. We're a top 50 mortgage company. So if I call them and beat them to the punch, because a lot of times they're calling me, but if I call them, it usually provides an advantage there. It's not going to make up for another offer being 50,000 higher than my client's offer, but all things being equal, they know that the mortgage is written with a company that's going to deliver. And so you've got to look for those other smaller advantages as opposed to risking it all with losing earnest money. So.
Right. That's saying that the listing agent is going to call if the listing agent has like 10, 12 offers on a property, which is a listing agent's dream, it's, she may not or he may not call each mortgage broker. They may call maybe the top 5, or they may not even get to that point. So the fact that you've already beaten them to the punch, that listing agent can say to the seller, look at, this mortgage broker has run all these things, knows them well, has done a couple of loans for them, feels very much at ease. So it does make a huge difference. So one of the other questions, and I do mostly the listing side, and, we've had a bad problem with appraisals. So you say your appraisals are in-house, the order desk is in-house.
Yeah, so when we order an appraisal, we're ordering it directly through our appraisal desk. We get updates on when the appraisal order was accepted, right? Because first it's got to go out to be accepted. And then we get updates on the inspection date. And when we place an appraisal order, we're setting an expectation with the appraiser. We actually set a due date for that appraiser to deliver it by. So if they can't make the due date, then they're going to turn down that appraisal. And it's going to go to the next appraiser who will accept it because they can meet that turn time. I'm now working with an office, a Keller office out in Central Mass that was dealing with a bank, and they couldn't get an appraisal back for like a month. And we've had great success with our realtor partners getting appraisals back quickly. And honestly, I haven't had one come in short, knock on wood, right? But it's still been okay in Massachusetts. Some of the other states I lend in, Vermont, 8 weeks for an appraisal to come back in some cases, especially if it's rural Vermont. So yeah, it's something to, it's something definitely to have a company that's going to hold that in-house. And these appraisers are getting so many orders from us. They want to keep us happy, right? We're the hand that feeds them. So they meet our dates and they get stuff back quickly and stuff. So yeah, something to keep in mind when searching out the right mortgage company.
So another thing we've encountered a lot lately, and I don't think it's just totally COVID related, it's we've had a lot of desktop appraisals. Now, what determines whether a property is going to have a desktop appraisal or desktop is, my understanding is it's an appraiser doing an appraisal from what they can see on the multiple listing service. They don't go out to the house, and they determine the house's value from what's on the multiple listing. And then the other type of appraisal is the appraiser actually goes out to the house. So why are they ordering more desktop appraisals, does it seem?
We actually don't see many of the desktops appraisals. What we do see more of right now is what's called an appraisal waiver. And so what happens is Fannie Mae and Freddie Mac, they collect a big data, right? So they know what an area's median house price is. And so if they've got a strong buyer coming to the table, let's say somebody's purchasing with 20% down, Well, Fannie and Freddie can go into their database and determine if the house is the value that we put in on the lending side is a fair value. And they can actually issue what's called an appraisal waiver, where no appraisal is done. So it's not just an appraiser doing a computerized appraisal at their home. It's actually the house never is looked at. The value is accepted based upon what the lender has put in there. On the purchase market, some people say, yeah, give me that. I'm okay. I know that it's worth what I'm paying. While others will say, let's do an appraisal. I just want to make sure it's worth the amount of money that I've agreed to pay for. So some people choose it, other people don't, but it's one less thing to have to deal with. And if you're looking at a very tight closing time frame, an appraisal waiver can go a long way in meeting those dates. So
now one of the things that in this market, because there's so many refis, how do you determine, because from our point of view, the purchasers should take preference. So does that happen in your company? And how do they do that?
Sure. Yeah, no, that's a great point, right? Because refis are feast or famine. And like I said before, we know the famine's coming, right? It may not be 2021, it may be 2022, but at some point in time, everybody in America is going to have a sub-3 interest rate on their house, right? And nobody's going to refinance anymore. If somebody needs cash, they're going to do it through a home equity line of credit as opposed to refinancing their first mortgage. Mortgage Network has always been a purchase-centric company. We know that our lifeline depends on us doing purchases and doing them well. So what we've done is we've implemented a few strategies. The first thing we do is we lock all refinance loans for 75 days. They typically don't take that long to close, but if we've been barraged with the purchases, we want to be able to push off that refi closing and get the purchases to the closing table, because nobody cares when a refi closes, right? It could be on a Wednesday at 6 p.m. Whereas the purchases, you've got those dates in concrete. So we've done that. So we lock refi loans way out to give us a big window on when we can close them. The other interesting thing that we've done, and I've heard of other companies doing this as well, is we actually shut down refis during the day. So we'll reach a point during the day, depending on how much refi business that's coming in, where we will say to all the loan officers, no more refi business today. And what we're doing with that is we're making room for those purchases that need to happen. So we only allow us as a company to take so many refis.
I have one more question.
Yeah.
This is the last question of the day. All right. So I've been doing this now for 22 years, and there was a period in time when people were using their house like a bank. They kept pulling more and more money out of it. And I'm wondering now, because my understanding is about 42% of people do not have a mortgage at all. And I'm wondering, because the rates are so cheap, are they actually taking, and this is just something you might be just hearing, are they taking money out of the house and putting it in the stock market or different investments?
Yeah, that's a great point. I've got a real world example that I can give you. So I got a call from a guy today in Massachusetts. He's got 7 years left on his house payments. He was in a 15-year, he's already paid off 8 of those years. And he has $215,000 owed left. And his original plan was his son would be graduating from college in 7 years, and he'd be mortgage free at that time, setting himself up for retirement effectively. He's actually thinking of going back to a 30-year mortgage right now, because mortgage rates that he qualifies for are in the 2s. And he says, he can invest that, put that money in a brokerage account, and in more years than not, he's going to get a better rate of return on that money than if he was to just leave it, on the 7-year mortgage that he has left. So he, going from a 7-year to a 30-year mortgage, was going to have an $1,800 less mortgage payment than what he's paying right now. And he's going to take that money and he's going to invest it. And he's going to come, he's going to make his equity work for him, is what his thought is. So a lot of people are doing that now. The mortgage interest rates are just so cheap that people are now starting to make their equity work for them. And equity is at an all-time high. We've seen house market appreciation be crazy lately, right? So we don't have all these people that have 5% equity. People that bought 5 years ago typically have a ton of equity that they can tap into. You know, they can buy a car in cash as opposed to paying Ford Motor Credit 6% interest, right? So there's all sorts of things that people are doing with their equity these days, given the rates.
It's going to be interesting to see what happens with the real estate market years down the road. When these rates do go up, you've got people that are not going to want to move so much because they can't get that rate again.
Right. We've gone through that, right? We've had those supply issues in the past, Deb, and part of it's because people had rates in the 3s on a 30-year fixed. And although they had outgrown their house, they didn't want to go to a rate of 5%. I think that problem may compound itself where we're now in the 2s, you know? People tend to stay a little bit longer and they hold on to that rate, you know, maybe even if they need that extra bedroom or they want that extra half bath or something, they make it work to hold on to that interest rate. So, but we're looking at a strong 2021. Mortgage rates likely will be in the high 2s, low 3s. You guys should do wonderfully as the purchase market, by all forecasts, is going to continue to grow in 2021. I know you guys, you know, you mentioned, Deb, that you guys have served a ton of families in 2020. So I can't imagine what it's going to look like at this time next year.
I think the spring market's going to start in January.
Yeah.
I think it's right after the holidays. We're going to come right out of the gate strong. So, well, Ryan, I just want to say thank you so much for joining us and being on our first Facebook Live. And please don't forget to contact Ryan Leahy from Mortgage Network. And we would love to hear from you what you'd like to talk about at our next Facebook Live meeting. And you can find us on Instagram at Lucci Team, and our Facebook is Deborah Lucci Team. And we'd love to hear comments, anything you'd like to chat about. We're open to it. We're going to have some more guests come on. Any different subject. We can think of home inspections, appraisals. We can think of first-time buyers. What do you do if you're a seller? We could go on and on. But any questions that you'd like us to talk about, any subjects, we're open. So thank you so much for joining us today.
Can I just cut in for 1 minute? Because we actually have one comment.
Okay.
We have, I don't know. It says other countries allow portable loan programs from house to house. I don't know if that's just kind of an FYI or a question or, but Dana had asked that. I'm not sure.
So they don't allow them to go, very few programs allow for anything like that, but they don't allow you to carry it from one house to another. Some programs are what's called assumable, meaning that if somebody was to buy your house, they could assume your mortgage, keeping the rates the same. But those are few and far between, and so it's not something to count on. And most times, the seller of the home wants their mortgage paid off before they get into the new home anyway. So we don't see mortgages really assumed at all, but they're certainly not able to be transferred from home to home.
Very interesting, though.
Awesome.
I didn't know about that.
Very good question.
Yeah.
Well, I just want to thank everybody for joining us today, and we look forward to seeing you on our next Facebook Live, and look us up on Instagram and Facebook. Okay? Thank you very much.
Thank you, guys. Have a good day.
Thank you.
Bye-bye.